How's it going, everyone? RoyalFlush here, meter management, not financial advice. Any of the stock I talk about are not advice to buy, hold, or sell. Take some good notes. Let's have some fun. Okay, so this one I want to jump right into. I want to go straight into it. I want to cover the topic of zero DTE credit spreads. So there's a lot to stomach with that one. Zero DTE. So zero DTE means 0 days to expiration. Normally when you buy or sell options, they have an expiration date. And if you're buying zero DTE, that means it actually expires the same exact day. So what that means is that option needs to actually, in this case we're talking about credit spreads, it actually needs to lose its value by the time you close it, or have less value than the price that you are playing for. I'll go over that as we get into how to open the credit spread. So it sounds complicated, but trust me, once you understand which side you're playing on, that will determine how you open up these credit spreads. One requirement of doing zero DTEs is I recommend that you have the access to day trade without limitations. So that means your account needs to be over 25K and kept that way until at least after the trading day. So just continue to build up your portfolio, but you need to bring in consistent gains. But above all, you need to be able to day trade. Okay, that makes you a pattern day trader. That's one highly recommended part of the strategy. Otherwise, just make sure you can have some trades to roll away until the next time you execute a day trade, okay? That goes for any day trade, really. Why would you want to do a zero DTE credit spread as opposed to just buy a call option or buy a put option? In the case of starting them up, it actually doesn't cost as much as just buying a straight up call or put option. So you can actually still bet on the same direction of bullish or bearish at a little bit less than buying a straight up call or put option. The only thing is, with it being zero DTE, you need to fully commit to the price action for it to be beneficial to you, and that could be a little tricky, and you should have some indicators to tell you which way your stock is trying to move, so you want to be on the right side of that. One disadvantage of it though is that you have to really commit to the play, or else when you start trying to close it, then it's actually going to be pretty costly just to close it. The one nice thing about it though is that sometimes, like say you're actually in a call or a put option, you wouldn't really know, if you're still new to them, you wouldn't really know when you want to get off, because you might think it's just going to continue to gain value. But with it being zero DTE, you're not, firstly, the maximum you'll ever be able to get on these is probably only in like the 90%. If you go for 100%, you have to hold at least until 12:30, okay? And even then, there will probably still be a small amount to buy to close automatically. So right here, right now on my Robinhood account, I want to go ahead and quickly show you how to open up a zero DTE credit spread. So there's a couple ways we can go about this. Zero DTE, not many tickers allow for same day expirations. So on any given day, Monday through Friday, you can actually do that on the SPY and QQQs, okay? As of this year, SPY and QQQs are allowed to have it so that you can actually do same day expirations on any single day. We'll go ahead and look at the options here, and you'll see that there's actually options for every single day of the week that you can trade. See, November 13, 14, 15, 16, 17. That means every single day here that's a trading day has the ability to do options on. Let's assume that we're on November 13th. That would be 2 days from now. That would be Monday, and the current share price is 370. Of course, the market's not moving because the market is closed. So first you have to determine whether you're bullish or bearish, okay? I would get in the habit of understanding the difference between the bull put spread and the bear call spread, okay? So if you're bullish, that means you need to buy a put. So we'll go to the share price. And so let's see, it's currently right above 378 by 8 cents. But let's see, if you're bullish, that means you want the stock to move up. Okay, so we would buy a put option first and then sell above that strike price, just like this. Preferably for my strategy, I prefer to do it as close as possible in terms of strike prices. As far as do you want the option to be in the money or out of the money, well, I guess I could show you that. So with this current option right here, this is going to be a bull put spread, so I'm bullish. I want the stock to go up. This one would here be an at the money call option, because the 378 is already slightly in, and then all it would have to do now is go past the 379. But as you can see here on this little slider here, you'll actually still be somewhat profitable even before it gets to 379. Okay, so when it's at the money, it's somewhat the cost of it isn't so bad, but you can actually do this a little bit differently. On the same bullish credit spread, we will actually go slightly more away. So let's focus on the 378 right here. If I do 379 and then 380, this would actually be out of the money just right now. So there's a noticeable difference in the cost to start this up. You see that's 39 and you're playing for a max profit of $61. So when you're out of the money on these, it's slightly riskier. Actually, it's much riskier. The further out of the money you go on these, it's riskier, because since you want this to happen same day, now you need to get past several more dollars of levels just to get where you need, and that herein lies where the tricky parts of writing these come. Okay, if you were to do an in the money one, let's go ahead and look at that on the same bull put spread here. So I'll close it. I'll do this. Let's say I wanted, since we're already above 378, let's say I wanted to buy the put option right here, and then the sell option above it. Okay. So as you can see here, now you're playing for a lesser amount of money, and now the max loss, this is actually the collateral you put up. So in order to play for $35, you have to put up 65. Quick calculation of how this works out. Difference in the cost of these options actually determines what you're playing for and how much collateral you need. So if I wanted to do the at the money one, I will buy this one and then sell this one. So that's where that $52 comes from. That is the amount of collateral you want, that you actually need to start this up. And then you're playing to earn up to $48. You're not going to get the whole thing, but if you get good at holding these and then closing them up out of profit, then you can consider wanting to do these. Preferably though, I like to do the at the money options or slightly out. So you don't want to choose your strikes too far apart from each other. If you're going to do these 0 DTEs on credit spreads, don't choose a big gap like this, where you have several dollars that you have to get through just to become profitable. That's going to make it so you have to put up more collateral, and you need to get through several levels of possible resistance. Okay? Before you get into actually committing to these, again, if you're bullish on this, understand that this is the bullish version, the bull put spread. So you actually buy a put and then you sell a put above it. Okay? Now if you're bearish, it would be the other way around. You would actually switch over to calls, and then let's say I want this thing to go down, I would buy the call and then sell the call below the call option. that. Okay. Same deal. So this one would be the at the money. And now if I want to go out of the money, we would go like this. Buy the 377 since the strike is 378. And then 376. Okay. So when you go out of the money on these, they cost less, but now you can actually potentially play for more. Okay, so if you have a small account, that's another thing that's really nice about these. It allows you to play for a capped amount of gains for less money. So you're not gonna get past 100% on any of these. You're playing for a fixed amount, and that's just how it is. So it kind of, in a sense, puts a limit on the amount you can gain, and also a limit on the amount you can lose. Okay, so say this thing expires in the red, then the most you're gonna lose is $25. But if it expires in the green by 12:30, you could get as close to $75. I'm gonna go over a few examples of some trades that actually I had success on. So let's go ahead and look at those. So on Wednesday, I traded the triple Qs. I went into a bull put spread, okay? It shows right here that I bought three of them at the 372 and 373 strike prices, okay? Let's go ahead and look at our Webull chart and see where we were. When I opened this, it was at 1008. So now I have the triple Qs here, as shown on Robinhood. It says I entered this play at around 1018, okay? So I have a strategy here, and that's called the 9 and 30 EMA crossover. That's usually when this white line here, this is our 9 EMA, crosses over with the 30 EMA. And since it's below these candles, and this was a bull put spread, that means I was bullish on this. So I opened it at around 1018, so it'd be in between here. And you can see there was quite a dip right here, so that would have picked up a lot of orders. And then the subsequent candles, well, I got in right here on the form of the cross. Okay, so right here it crossed, and I must have already gotten picked up. This is already at the 1030 mark. And then so it continues to take me up. And then now it says I got out somewhere at 11. Let's see when it tells me when I got out. It shows right here that I got out at 11:18. I think my reason for that was because there were supposed to be some Fed speakers at 11:40. So I wanted to make sure I got out when my trade was still profitable. So if I got out at 11:18, that means I got out right around here while the candles are still nice and green. Okay, let's go and see how much I got out of that. So I bought the 372 strike and sold the 373 strike, same day expirations, and each of them cost $53. So that's, for each one I'm playing for about $53, and that's why we get 59. And then so that means if I'm playing for each of them for 53, I need to sell each of them for less than $53 each, and I believe I sold them all at once at a price of 37. So 53 and 37, 53 minus 37, that would be $16 each. So combined total, that was $48. $48 and 30% in the play. Not bad. Let's go ahead and look at another credit spread that I played on Friday. That was yesterday. This was actually my best play of the week. That would be on Costco. Okay. So let's see. Costco put credit spread, bull put spread right here. So I was bullish on Costco. It looks like I opened up the 372, so I bought a 372.5, and I'm aiming for above 575, okay? And I am playing for a total of about $123. Let's go ahead and look at Costco's chart and see what was the play as to why I decided to go this way. So it says at around 8:47, I got in. I got picked up on this put credit spread, bull put spread. 847. So at 847, we're right about, let's say right about here at 845. Okay, so we're well above in the green. I think I actually bought a call option on Costco and sold it for about 21%. I sold a call option for 21%, $43. What's to look at besides all these green candles? I have my VWAP indicator here, and as you can see, there was a gap up at opening. On top of that, there was already an EMA crossover, just based on the bullish price action. But we did have a crossover here with the 9 and 3. The 9. We had a crossover here with the 9 EMA with the VWAP. So this tells me already that today is going to be a very bullish day, because I got in on this at 847. And since I chose the strike price, the buy put option of 572.5 at 847, we were slightly in the money, or at the money. Yeah, we were slightly at the money with the put option, and then our target is 575. As you can see here, we actually stayed well above 575 for basically the rest of the day. What really matters was staying above 575 till 12:30. That was my original goal, but I did close it somewhere around here, I believe. So it shows here that I closed it at 10:05, and I closed it for, so since we were playing for 123, I bought to close for 49. So that means between 123 minus 49, I actually gained $74 and a total of 60% on the play. So that adds up, right? Remember, since these are sell type options, you actually have to buy to close. The initial amount that is shown here, since the difference between the strikes is 250, the other 250 here would be, so you would subtract this number from 250, and that's the amount you need to put up as collateral. 250 minus 123. I needed $127 to enter this play, so somewhat costly, but not bad when I already knew that this was bullish price action. But yeah, $74, 60%, that's a very good return of investment on the play. Why did I arrive at actually liking zero DTE credit spreads? When I learned how to do options, I actually learned how to sell covered calls first before anything else. Before I got into selling cash secured puts, or even buying calls or buying puts, which is what most people do, I normally would acquire 100 shares of a stock and then sell options to gain premium. And while that is still one of my main strategies that I still do as part of my main ways to grow my account, zero DTE credit spreads allow me to day trade them because I can day trade. That's one. And two, I'm able to do it more actively when they're just kind of happening in the background. A few special things that you should know about zero DTE credit spreads. Aside from SPY and QQQs, where you could do those basically every single trading day, on Fridays or anytime there's like a Friday holiday or the end of the trading week ends before Friday, but typically, let's just say Fridays. On Fridays, all tickers allow for zero DTE because all options expire on Fridays typically, whether they're weekly or monthly or even bi-weekly, whatever your ticker allows, they always expire on Fridays, which is why I showed you Costco. That one is it has weekly expirations, but I look for them because if I can do zero DTEs on tickers that move heavily in either direction, and if I'm right on the move, then you can do zero DTE credit spreads on these for a little and gain a lot. So that's why I actually very much look forward to Friday zero DTEs, so I could do it on Costco, Nvidia, Tesla. Because otherwise, when you play on Fridays, you should buy at least a week out. If you're gonna day trade, I do not recommend doing regular calls inputs on 0 DTE Fridays. Your option is gonna get chomped up unless the price action moves very quickly. So normally you would have to buy 1 week out, and sometimes those contracts, you know, are probably gonna be above what you're willing to afford. So if you do a credit spread, you know, all you need is, you know, maybe couple like $40 or $70 to play for, you know, more than that, you know. So it has a nice payout for the amount you have to put in. But yeah, I prefer 0 DTEs on Fridays, but on times when I don't want to put up as much collateral just to play an option, I prefer 0 DTE credit spreads. But most of the week I have to play on SPY or QQQs. But yeah, with my examples that I showed you using my indicators, all you have to look is for a EMA crossover above the VWAP, and if it's already well above the VWAP or below the VWAP, all you have to do is look for the EMA crossovers. We can actually look at the trade one more time. As you can see right here, much of the day was actually on quite a bit of a downturn, but when I entered to get bullish on this crossover was already forming towards the VWAP and actually broke the VWAP. So pay attention to where the VWAP is and where the crossover occurs. If this crossover occurs and it's getting close to the VWAP, there's a good chance that the candles are going to start leveling above the VWAP in this case. If things start breaking down, then we go below the VWAP. So using your technical indicators, and I have my levels here. When I wrote this one, I went for the 372, so I already knew that if this level breaks here, we're gonna break above it on its way to 373, but we didn't quite get to this yellow line here, but we did almost get to 373, which was my target, and you know, got a nice little return there. With this 9 EMA and VWAP crossover right here, well below the candles, it's gonna get a really big move, because after that, the price action is carried by the candles and well above the VWAP. The VWAP is never even close to getting touched again. 0 DTE credit spreads, they've taken quite a bit of practice for me to get used to, and while I won't use them as often as I used to before, because now I am actually buying calls and buying puts, I'll still use it when I feel like the price action will allow me to put up a little less collateral and then become in the money, and then I can collect my gains and buy the close for profit. Okay, so again, real quickly, if you're bullish, bull put spread, you buy a put and then you sell a put above it. And then if you're bearish, bear call spread, you buy a call option and then you sell a call option beneath it. So just make sure you get those two down, and remember these are sell type options, so you buy to close them. The amount that you get at the beginning is the amount you're technically playing for, and then there's a collateral that is the difference of that amount you're playing for. Okay, so just make sure you understand these things when you open it, and when it says both of them are filled, you're in. Okay, so make sure you buy to close for less than you sold the option for, because even though it is a sell type option, you don't get the credit until the option is closed. Okay, you buy to close it and then you collect the difference. So hey, if you like this strategy, let me know, and tell me what tickers you like it on. Personally, I like it on the big name tickers that I know swing big. So when I'm not doing it on SPY or triple Qs, I commonly play triple Qs on almost every single trading day. On 0 DTE Fridays, I will play it on Tesla, Netflix, Costco, Nvidia. These are tickers that move, you know, anywhere from $2.50 to 10, or sometimes even more. So if your strike prices are in on the way towards it, then you can, you know, collect your premiums and, you know, make a nice little trade. It doesn't have to be all calls and all puts. As long as your trade is profitable and you can continue to repeat it, then you can consider using 0 DTE credit spreads as part of your system. So let me know what you think. what stocks are you gonna do it on, and if you think this can work out for you. Anyways, get on out of here, but in order to earn it, you're gonna have to learn it. In order to get what we desire, you gotta jump through the fire. See you guys later.